The Bank of Korea kept its key interest rate steady for the fifth straight time amid eased inflation, but it hinted that it will maintain strict tightening policy for a considerable time as growth risks heighten on persisting uncertainties. U.S. Fed Chair Jerome Powell showed a similar stance, saying the U.S. economy's solid growth could require more rate hikes to fend off inflation. So for a deeper look at the current interest rate, its implications, and what to expect ahead for the remainder of this year, we're now joined by Professor Yang Jun-seok at the Catholic University of Korea. Good morning, Professor Yang.
Good morning.
So the BOK has kept its benchmark rate unchanged at 3.5%. What are the main factors behind the central bank's latest rate decision?
Well, when we look at the latest economic statistics, some of them are telling BOK to raise the rates, but others are telling BOK that it might be time to lower the rates. So obviously BOK is in a big conflict, and they may sort of have punted over the line, saying, let's look at the situation and let's wait until what happens. So that was probably the reason why they held the rates at this time. But let's take a look at some of these factors. If you look at some of the factors which should have made BOK raise the interest rate, it's still high inflation is the biggest one. The 12-month headline inflation is 2.3%. So that's slightly above the BOK's 2% target, but core inflation is still over 3%. 3.3 and 3.9, depending on how you calculate it. And interest rate gap between U.S. and Korea is still at the historically highest level of 2 percentage points. And perhaps partially because of this, the won has depreciated rapidly from 12.80 to 13.43 won per dollar in mid-August. So the won has been strengthening in the last 2 weeks. So now it's around 13.24 won per dollar. And lately, household debt is rising rapidly. So high inflation, depreciating won, and rapidly rising household debt usually would signal interest rate increase by BOK. But I've also said that there were factors which was telling BOK to lower the rates. The biggest is very sluggish economy. The second quarter consumption, if you look at the GDP growth, consumption and investment were down. And while the economy did show signs of recovery in the month of June with increases in consumption, production, and investment, as well as consumer optimism being up, the official numbers for July are not yet in, but there are wide concerns that the numbers will be down. And there's also signs, anecdotally, that consumption is falling. Store owners are reporting that sales are coming down, and inflation is coming down quickly, which is partially good news, but it also means that the demand is very, very weak. So the domestic economy is down, and exports are obviously down also. We have been in a trade surplus back in July, but for first 20 days of August, the trade account was back in deficit, but perhaps worse than that, exports were down by 16.5% compared to last year, and imports were down nearly 28% from last year. So basically, all demand factors for the Korean economy are right now getting weaker, and that signals that perhaps BOK should lower the rates, and BOK, as I said, is sort of caught in the middle. So they may be saying, well, let's just wait and see which works out.
As you mentioned, Dr. Yang, at the top of this segment, the BOK is being led by maybe different sets of stats, either to raise the rates or lower the rates. But what's clear is BOK Governor Lee Chang-yong stated that it's too early to discuss rate cuts. He cited Korea's snowballing household debt as one of the main components that could potentially drive up the interest rates again. This is while the finance ministry expects consumer prices to rise by more than 3% from a year ago by next month. Given these conditions, what is your projection of Korea's interest rate trend for the remainder of this year?
Okay, well, let's see what's driving those factors. The household debt is rising again. It's a big weakness in the Korean economy. While the number differs slightly depending on who's doing the calculation, the numbers usually show household debt for Korea being over 100% of GDP. That's among the highest in the world. And corporate debt also is over 100% of GDP and among the highest in the world, though they're ranked slightly below other really high countries. If you compare Korea's ranking for corporate debt versus ranking for household debt. But because these two debts are over 200% of GDP, total private debt is over 200% of GDP, which is already slowing down consumption and investment. And it may act as a danger signal for the Korean economy, not just the drag. And one of the psychological problems that we have at the moment is that we know the Chinese economy may be in a serious problem, and that's because they have a very high level of debt. Their debt to GDP ratio is thought to be over 300% of GDP. But so far, if you add up Korean household, corporate, and government debt, we're about 240 to 250% of GDP. So we're better than China, but we're not exactly all that great either. And because of that, Korea cannot really afford to have higher household deficit. The household deficit seems to be rising because the housing market is doing better. So this is, in some ways, a fundamental problem with the current Korean economy. We want the housing prices to come down, but if we do, then there's a lot of problems because lower housing prices means lower assets for the people, as well as possible problems in the construction sector and the financial sector, which is why the government tried so hard to keep the housing prices from dropping further. But when the housing prices go back up, people look at housing as speculation, or they figure that this is a good time to buy housing, which is very expensive in Korea compared to other countries. So you have increases in household debt. So it's sort of a situation where you can't go forward and you can't go backwards. And now household debt is rising again. So now that has become a major problem. Another factor, the inflation. Right now, headline inflation over 12 months, as I mentioned, was only 2.3%. But the core inflation was considerably higher. So inflation came down, but mostly due to fall in food prices and oil prices. But now oil prices are rising again. And there was a Bank of Korea report saying that food prices are likely to increase starting this month as well. Domestic food prices always rise before Chuseok, which falls on late September this year. So this is around the time when food prices would be going up anyway. But this year will be particularly worse because the weather has been so bad, too much rain and too hot temperatures. And then international food prices are also on the uptick because weather was strange around the world, not just in Korea. So the factors which brought the inflation down may be driving back up again. And government has warned about this in the past. They expect that they had been saying that inflation would return to 3% level in the next few months. But because of that, we will have higher headline inflation. So that also doesn't bode well for BOK trying to lower the interest rates.
Korea's financial authorities have repeatedly said things will look up in the latter half of this year. It was charged with a little bit of hopeful optimism, waiting on the Chinese economy to open, to no avail. The BOK governor cut Korea's growth forecast for next year from 2.3 to 2.2% on slower Chinese economy, as we've discussed several times on this segment. Does this mean we're in for a longer period of difficult times than previously expected, Dr. Yang?
Very likely, the IMF and other international agencies have lowered their forecasts for Korea slightly throughout the year. Now, that's mainly because Korea's exports have not been recovering, and the reason that Korea's exports have not been recovering is because China's exports have not been recovering. As we said, Korea's exports are tied to Chinese exports because what Korea exports are mostly intermediate parts for China to make their exported goods. Korea exports very little consumption goods to China, so we want to have China's exports go up, but Chinese exports have been lower this year consistently than last year, and even their exports to U.S. has been going down rapidly this year. So until that picks up, Korean exports are probably not going to pick up. But then why is China's exports down? Right now, the best guess is no one's quite sure exactly why it went down so much. But the best guess is that the global economy is going down. We only basically have one engine of growth. The IMF was looking forward to recovery starting late this year for the global economy. They were counting on two things. They were counting on the U.S. economy being strong. They were counting on Chinese economy being strong. Now, U.S. economy is still going on very strongly. Their third quarter GDP may be as high as 5% if you annualize the rates. But a lot of analysts are saying that there are some signs that, well, the U.S. will not go into a recession, but they may get into a slowdown. European economy, they seem to be recovering nicely until last week when we had some reports, some statistics, which may signal that the European economy is slowing down. But the definite sick man in the crowd is China because of their declining exports and because of their domestic problems with the debt and the housing market. Consumption, investment are all down, and they may not be going back to the fast growth pace for quite a while, if ever. There are a lot of people arguing that this is a permanent slowdown in the Chinese economy. So if that is so, then Korean growth will be in a doldrum for a long time. But let me just mention one other thing. Governor Lee has said that the Korean economy may he lowered the growth rate estimates to 2.1%. And this may be the new normal. And the reason I say that is because, well, we have what's called a potential GDP growth rate, which is where we expect the growth rate to be normally. And we believe that it is declining because of falling productivity and declining population. So right now it's in the low 2% range, and voila, that's what the growth estimates are for next year.
And that seems to be a projection for the long haul. That's a big takeaway. No rosy outlook there. There's one last question that we wanted to ask you, Professor Yang, before I let you go. Of course, the highly anticipated Jackson Hole meeting. It took place with the Federal Reserve Chair Jerome Powell in attendance. He said that the continued strength of the U.S. economy could require further interest rate hikes. It must be said it's not a policy setting meeting. Nonetheless, it sets the tone. So a lot of eyes were watchful as to what the Fed chair might say. The markets project that the Fed will soon begin its rate cut unless major unexpected variables pop up. Would we see a U.S. rate cut within this year based on your expertise?
Okay, well, the Fed and the market have been having this fight basically for slightly more than a year now. Powell saying that he will not lower the rates. The market keep on estimating that they will lower the rates. Markets have been consistently wrong. But there might be at least, if not an explicit wish, then a subconscious wish for the market saying that they want the rates to come down because when the rates come down, the stock market as well as other financial markets, they tend to do better. So because of how they want the stock prices to go back up, the market is market does want the rates to fall as quickly as possible, but Powell is probably not going to do that unless the U.S. economy just suddenly gets into a very, very serious recession or a depression, which is very unlikely at the moment. And the reason is that, well, the two of the biggest tools that the Fed uses to try to control the economy, one is forward guidance, where the Fed tries to give an idea that where they're going to move in the future. And then the second tool is that the Fed must maintain credibility about their moves. And if Powell, after saying so consistently since the beginning of the year that there will not be a rate cut this year, where if he does lower the rate before the end of the year or even early next year, then first of all, he's going against his word. So the credibility of the Fed may be lost. And then he has been saying that he will not lower the rates consistently, but if he does lower the rates, then that means that whatever word that comes out of Powell's mouth from then on will not be trusted. And so it not only affects credibility, but the forward guidance, because, well, then now we don't know whether we can trust any Fed statement. We don't know whether the rates will go up and down. So Fed will lose a lot of credibility. It will lose a lot of the ability to use so-called forward guidance, and that would mean disaster for the Fed in the future. If you want to lose those tools, or at least you want to justify why he went back on his word that he's been giving consistently for the last year, you need that big a disaster. That's why if U.S. does lower the rates, it will require a very large recessionary signals or even a depression signal. And right now, those signals are just not there.
Thank you very much, Dr. Yang, for your insights. Appreciate it. As always, we'll speak to you again next week.
Thank you.
If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.